Ladies and gentlemen, today we're diving into one of the most pressing and peculiar financial developments coming out of the global south, India. While the headlines are painted with optimism about its growth story, underneath lurks a web of contradictions, systemic issues, and increasing reliance on fiscal maneuvers that could potentially spell long-term challenges for its economy. At the center of this emerging narrative, India's youngest infrastructure lender, the National Bank for Financing Infrastructure and Development, NaBFID, which has been playing an unexpected and outsized role in India's financial markets. The question is this a clever tactic to manage funding pressures, or does it hint at bigger structural and governance flaws within the Indian financial system? Let's break this down from point to surface, as I always say, and connect the dots to get a clearer picture. Why is NaBFID's hedging spree in the interest rate derivatives market causing so much chatter? Why is this a symptom, not of financial innovation, but of deeper economic problems? Stay with me until the end because you won't want to miss the implications this could have, not only for India's economy but for global investors, financial professionals, and ordinary citizens alike. NaBFID has surprised many financial analysts and policymakers through its aggressive activity in India's interest rate derivatives market, specifically by trading in overnight indexed swaps, OIS, and total return swaps, TRS. These tools, commonly used for hedging interest rate volatility, have instead inadvertently influenced the market in a way rarely seen before. By receiving fixed rates to hedge against falling interest rates, NaBFID is exerting downward pressure on OIS rates, creating a situation where India's 5-year OIS rate now stands at 6.25%, a full 6 basis points lower than before. Now, what makes this intriguing is the divergence between Indian swap rates and the typical benchmark movements of U.S. Treasuries. Usually, Indian rates move in tandem with U.S. Treasuries due to the dominance of foreign banks in India's local bond markets. But lately, Indian swaps have decoupled, almost as though living in their own universe. On a superficial level, this might sound like a calculated masterstroke, but is it really? Before we applaud the National Bank for its innovative approach, let's zoom out and view the bigger picture, India's slowing economy. Yes, you heard me right, folks. The supposed world's fastest-growing major economy is quietly grappling with lower than expected growth, higher borrowing costs, sluggish domestic demand, and a rising fiscal deficit. Here's where things get concerning. NaBFID's extensive hedging operations are tied to its issuance of long-dated rupee bonds, worth 81.91 billion rupees, $970 million, just between April and September of this year. This would make sense if India was operating in a stable financial environment. But the move to hedge aggressively against a decline in interest rates shows how volatile and uncertain the economic outlook has become. The irony? While NaBFID shields itself from unpredictable rate changes, this heavyweight activity itself distorts market pricing mechanisms. For all the headlines celebrating India's economic resilience, indicators suggest otherwise. GDP growth slowed to 6.1% in 2023, down from a peak of 8.7% in 2021. Meanwhile, unemployment figures have shown a stubborn upward trend, with urban unemployment hovering above 7.5%. When growth stagnates and fiscal pressures mount, the government's policy tools often spill over into unconventional market interventions, and this seems to be one such case. On the surface, lowering borrowing costs to stimulate lending and infrastructure development looks like a win-win for everyone, right? But inflation hasn't been tamed yet. India's retail inflation reached 6.8% in August 2023, well above the Reserve Bank of India's (RBI) tolerance band. The RBI has repeatedly emphasized its unfinished battle with inflation, but how sustainable is that stance when government-affiliated entities are pushing rates artificially lower? This creates a clash between fiscal priorities, cheaper funding for long-term projects, and monetary policy objectives, curbing inflation. Here's the kicker. By dominating the derivative markets and indirectly influencing funding costs, NaBFID may end up crowding out private sector banks and borrowers. With a shrinking pie of capital available for investment, small and medium enterprises, already reeling from post-pandemic challenges, face higher barriers to entry, further stalling job creation and economic recovery. If history teaches us one thing about state-backed entities like NaBFID, it is this: they often act as instruments of government policy rather than independent financial institutions. While the official rationale behind NaBFID's hedging spree is sound risk management, one cannot ignore the possibility of implicit political motivations. NaBFID was set up in 2021 as part of India's renewed push toward infrastructure-led growth. But with fiscal deficits climbing to 86.4% of the full-year target in just the first half of FY24, the capacity for direct government spending is eroding. By influencing lower rates in bond markets, NaBFID indirectly enables the government to borrow more cheaply and avoid making tough fiscal decisions. For an institution managing billions in public-backed funds, NaBFID's operations remain opaque. The anonymity of bank counterparts in swap trades and the limited public disclosure of risk management practices raise questions about accountability. If markets suddenly react adversely, who takes the fall? By socializing financial risks while privatizing gains, NaBFID is setting a dangerous precedent. If interest rates move unfavorably in the future, the Indian taxpayer could ultimately foot the bill, a tale all too familiar in global financial crises. India is not the first country to leverage state-backed entities to manage funding costs. China, for example, extensively uses state-owned banks to mask inefficiencies in its financial system, often leading to credit misallocation and unsustainable debt levels. The shadow of Japan's lost decade also looms large, thanks to years of low interest rates propping up zombie firms at the expense of innovation and competitiveness. The question now is, does India risk walking the same dangerous path? Financial professionals should be asking whether this heavy-handed intervention is a temporary fix or the start of a systemic problem. For investors, policymakers, and ordinary citizens, here are the key takeaways. 1. Erosion of market integrity. When state-affiliated institutions like NaBFID distort pricing mechanisms, markets cease to function as efficient allocators of capital. This increases systemic risk, and makes it harder for you to trust the numbers on your Bloomberg terminal. 2. Global spillovers. India's decoupling from U.S. Treasuries might look good now, but in a globalized capital market, investors will eventually question why the divergence exists. If confidence erodes, the rupee, already volatile, could face significant depreciation pressures, impacting not just foreign investors but also domestic consumers reliant on imports. 3. Long-term implications for taxpayers. A government that borrows cheaply today often imposes higher taxes or inflationary consequences on citizens tomorrow. Are you ready to pay the price? NaBFID's activity in the swaps market is a microcosm of India's broader economic struggles, slowing growth, fiscal pressure, and a government increasingly reliant on intervention rather than reform. While the current hedging policies may keep funding costs under control temporarily, the long-term risks are glaring. By focusing on short-term wins, India risks undermining the very principles of transparency and free market dynamics that underpin sustainable economic growth. Friends, the question going forward is not about whether NaBFID can continue these maneuvers, it's about how long the illusion of stability can be maintained before the underlying cracks become too visible to ignore. So, buckle up, because the road ahead may be bumpier than it looks. As always, keep your eyes open and your wallet safe. Until next time, this is your guide to decoding the world's economic chaos, signing off.